Hedging with gold futures in volatile times. Gold is seen by many as a safe haven asset for preserving wealth when the world feels uncertain. During such times, its price tends to swing more. For example, since the COVID-19 pandemic in 2020, gold rose from around $1,450 to $3,500 per ounce by April 2025, attracting many investors to the gold market. However, fast-changing market conditions and volatile price movements in today's unpredictable economic and geopolitical environment also present a potential risk of loss. One of the effective ways for investors to manage risk and protect their gold assets from fluctuations in the market is by using hedging. What is hedging? Hedging protects against possible loss in an asset by compensating transactions on the other side. In other words, by taking an opposite position in another asset. We can think of it as insurance for your investments. Just as you buy insurance to protect your home from unexpected damages, hedging helps protect your investments from adverse market movement. For example, if you own gold and fear that the market might decline, you could hedge by having a position in an asset that tends to rise when gold prices fall. This way, if your gold portfolio loses value, the gains from your hedge can help offset those losses. The futures markets provide contracts designed for risk management. Investors and market participants can use futures contracts to hedge against price movements in an underlying asset to help manage risk and prevent losses. Hedging functions on the principle that the cash or physical market prices move closely with the futures price. Thus, hedging with futures involves executing a futures position opposite to one's current position in the cash or physical commodity market. In this scene, you will see how to use Bursa Malaysia derivatives, BMD gold futures, FGLD, to hedge your gold exposure. FGLD is a US dollar denominated in Ringgit Malaysia settled gold futures contract. Each contract of FGLD is equivalent to the reference price of gold per troy ounce, multiplied by the contract multiplier of 40 per contract. If gold trades at $2,500 per troy ounce, the contract size equals 40 multiplied by 2,500, or a $100,000 M. Every $1 movement in gold price per troy ounce is thus equivalent to Remeg 40 M. For example, if you are an investor holding 300,000 ringgit worth of gold and believe that the market may see a price correction after a steep rise and wish to protect the investment from falling prices, you can hedge the position by selling futures equivalent to the current gold holdings. The number of contracts to sell is determined by dividing 300,000 ringgit by the contract size of FGLD. Say that FGLD is trading at US $2,500. The contract size is equivalent to 100,000 ringgit, 40 by 2,500. Divide 300,000 ringgit by 100,000 ringgit, and you will get 3, the number of FGLD contracts to sell. By selling 3 contracts of FGLD, you have taken an equivalent position in the futures market, which is opposite to the exposure of your gold holding. Let us see what happens to this hedged position if gold prices drop by 10% from $2,250 to $2,250. Your gold holding will lose value by 10% or 30,000 ringgit. Your FGLD position of 3 contracts will be in a profit of 250 times 40 or 10,000 ringgit per contract for a total of 30,000 ringgit profit. You will offset the 30,000 ringgit loss in your gold holding with the 30,000 ringgit gains in your FGLD position, thus protecting yourself from the decline in gold price. However, once you place the hedge position, monitor the market conditions and adjust the strategy as needed. If you believe the outlook for gold is no longer bearish, you will need to unhedge it and close the futures position by buying back 3 FGLD contracts. Get bullish about learning.